Good day and warm welcome to Shaped Theory. Today in this video, we will be looking at depreciation and accumulated depreciation. We have to take into account that in this video, we are looking at cost-based accounting and not advanced accounting principles where fair value accounting is taken into account. This is part 2 of the balance sheet item series that Shaped Theory is running. Do make sure that you check the other videos relating to this series to make sure that you understand the common items that are in the face of the balance sheet. If you need to read more about these and other accounting related items, please visit our website, which is www.shapedtheory.com. Now, let's look at defining depreciation in simple terms. Depreciation it is when the value of the fixed asset purchased decreases over time. This decrease starts immediately after the asset is ready for production. Let's look at an illustration of how an asset depreciates. In essence, if you buy an asset today, it will not retain the same value throughout its life. Therefore, we can say the asset we bought today will depreciate over time because it will have lesser value in the future or over time. To give you a practical example, you will see on my slide that you can buy an asset for 1,000 currently, and in the following period, the value of that particular asset will not be 1,000, but will be less than the 1,000 that you initially bought it for. In this slide, the value in the next period is 900. This shows you that the asset has depreciated to the value of 900 over time. Now, the difference between the 1,000 that you bought the asset for and the 900 that you have in the next period is called depreciation. In this example, we can gladly say that we bought the asset for 1,000 and it has depreciated by 100 and now it is worth 900 on cost basis. Now, this slide looks at defining depreciation and showing you what is the impact of depreciation on the cost of the asset. The following slides will show you how you can calculate that depreciation amount that we've been speaking about. Let's look at common depreciation methods that one can come across in various industries. The first method is straight line method. Straight line method is where the depreciation is calculated to be an amount after you have deducted the residual value and dividing that particular amount by the useful life of the asset. This value is used to reduce the value of the fixed asset gradually over the useful life of the asset in the balance sheet. The second one on my slide is diminishing or declining balance method. This is a method where the depreciation is calculated to be an amount after deducting the residual value, the accumulated depreciation of the prior periods from the cost price, and then dividing that amount by the useful life of the asset. This amount, which will be referred to as depreciation, will be used to reduce the value of the fixed asset over its useful life. If the asset does not have a residual value, we will only deduct the accumulated depreciation from the cost price and divide that by the useful life of the asset. The third one is units of production method. This method is mainly used in a factory or manufacturing setup. The method is based on the number of units estimated to be produced by that particular fixed asset throughout its useful life. It has to be noted that on this method, management has to perform a detailed assessment on estimated units that can be produced by the asset. As I've mentioned before, this depreciation method is mostly applied to production assets or assets that are used in a manufacturing industry or manufacturing setup. Now, Though all these methods are acceptable and depends on the company's accounting policy, the most common used methods are straight line method and diminishing or declining balance method. Let's look at the straight line method. In this slide, we are going to look at an example of a straight line method in looking at how the depreciation is calculated on the straight line method. So let's say company A buys an asset for 1,000. The residual value of this asset is 100. Some refers to the residual value as a salvage value or any other term that you can come in the industries. And the useful life of this asset is 5 years. Let's look at how we can calculate depreciation using the straight line method on this example. We will first take the actual cost of 1,000 and less the residual value of 100, which will give us an amount of 900. This is an amount that we should use to calculate the depreciation amount. We will therefore take the 900 and divide it by the useful life of the asset, which is 5 years, which will result in a depreciation of 180. This is how we calculate depreciation using the straight line method. If we happen to not have the salvage value or the residual value, then we will only use the cost of the asset and divide that cost of the asset by the useful life of this particular asset. Now, let's look at the diminishing or the declining balance method. Let's say company A bought an asset in year one of 1,000 and the depreciation for the first year was 200. The useful life of this asset is 5 years. The first thing we will need to do is to deduct the accumulated depreciation from the cost price of 1,000. In this instance, we will say 1,000, which was the cost price of the asset, minus 200, which gives you an amount of 800. It should be noted that if the asset has a residual or a salvage value, it has to be deducted on this step as well. So on this example, we will therefore take the 800 that we have calculated above and divide it by the useful life of the asset, which is 5 years. This gives us a depreciation amount of 160. This means that the current balance of our accumulated depreciation is 360, which is the 200 of the year one or previous year plus the 160 of year two or the one that we have just calculated right now. In the previous slides, we have looked at depreciation and how it is calculated. In these slides, we look at the accumulated depreciation and the impact of both depreciation and accumulated depreciation in the financial records. Accumulated depreciation is the sum of all depreciation amounts that have accumulated over time to the current period. In the previous slides, we have said our depreciation amount is 360, which is the prior year amount of 200 plus the current year amount of 160. Now, the depreciation you have or the depreciation you calculate in the current period will be recorded in the income statement or profit and loss statement as an expense in that particular current period. The contra entry of this will increase the accumulated depreciation in the balance sheet or the statement of the financial position. In a nutshell, the depreciation amount of the current period goes to the income statement and the contra entry of it is recorded in the accumulated depreciation account in the balance sheet. If we had to show it in an accounting journal, we would say in period 1, we had depreciation of 200, which was debited, and accumulated depreciation was credited using the same amount of 200. In period 2, the depreciation amount was 160, which will also be debited, and the accumulated depreciation will also be credited using the same amount of 160. Now, you might be asking yourself, how do I reflect the accumulated depreciation balance in the balance sheet? You will see that on the right side of the slide, we have what we call a T account. A T account works in the same way as journals. The left side of it is the debit side, and the right side of it is the credit side. As mentioned in the journals on the left, you will see that the accumulated depreciation account has an amount of 200 for period 1 and an amount of 160 for the second period, which brings us to the total accumulated depreciation amount of 360 at the end of period 2 or year 2. If we had to calculate the book value of the asset, we will say the cost price less the accumulated depreciation that we have calculated above, which will give us the book value amount of 640 at the end of period 2 or year 2 as shown in the slide. Now, that's it for now. Thank you for watching this video. Please don't forget to subscribe to our channel for more videos like this. Don't forget to also check the other videos relating to balance sheet items for better understandings of those other balance sheet items in the face of the balance sheets or annual financial statements. If you want to read more about other finance related topics, please visit our website at www.shapedtheory.com. Thank you very much. Good day and warm